Welcome. You're viewing the video version of the Santu Pirls Stock Market Commentary for July 10th, 2016. Market breadth. With this past week's market advance, our bull-bear point and figure ratio fell slightly to 1.64 from 1.67 last week, continuing within bullish territory. The total count of securities in bullish or bearish patterns decreased 2% to 2,882. The count of bearish stocks decreased fractionally, while the count of stocks in bullish patterns decreased 2%. The Santu Pirls P&F Market Breadth Summary Chart shows us a market now 2 consecutive weeks in bullish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly email version of the Santu Pirls Stock Market Commentary free of charge, simply enter your email address in the space provided. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 105 points for the 14th advance in 21 weeks. At a positive 195.29 points, it has risen above the November 2014 high and continues below all 5 other highs above plus 100 and continues above all 6 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in accumulation mode with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 0 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Momentum. Currently in a Woody's downtrend at a positive 150.24, the CCI 20 daily now has 3 consecutive days above zero for a likely change of Woody's trend to up this week. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 10 weeks ago, while the daily CCI 20 began a Woody's downtrend 2 weeks ago. The CCI 20 weekly rose to 82.61 from minus 7.81 last week, forming a zero-line reject long entry signal for Monday, 7/11 open. We will follow the results of this trade simulation in next week's commentary. Industry rotation, the last 2 weeks. All of the top 5 industries are positive, and 3 of the bottom 5 are negative. Summary: precious metals, S&P retail, and REITs on top. Banking and tech on the bottom. Bullish, REITs continues in the top 5. Brokers has left the bottom 5. Oil services has entered the bottom 5. Bearish, KBW Bank and disk drives continue in the bottom 5. Gold and silver continues to lead the top 5. Focus this week from Charles Hugh Smith's www.of2minds.com blog. Risk on, risk off. What schizophrenic markets are telling us. The following are some key points. In the conventional investment perspective, risk-on assets, that is, investments with higher risks and higher potential returns, such as stocks, are on a seesaw with risk-off assets investments with lower returns and lower risk, such as treasury bonds. When risk appetites are high, institutional managers and speculators move money into stocks and high-yield junk bonds, and move money out of safe haven assets such as gold and U.S. Treasuries. But recently, markets are no longer following this convention. Safe haven assets, such as precious metals and treasuries, are soaring at the same time that stock markets bounced strongly off the post-Brexit lows. Risk-on assets, stocks, rising at the same time as safe haven assets is akin to dogs marrying cats and living happily ever after. What the heck is going on? Why are markets acting so schizophrenic? What's changed? In broad brush, the tide that raised all risk-on boats for the past 7 years is now ebbing. The momentum has clearly shifted to the risk-off safe haven assets, such as precious metals and sovereign bonds. This flood tide of cash into bonds has helped push yields into negative territory, an unprecedented development. Owners of capital are so concerned about getting their money back that they are accepting negative returns, that is, guaranteed losses, to park their cash. Indeed, the flood tide of money into precious metals is attracting speculative hot money. Chinese day traders are behind silver frenzy moving prices, according to Bloomberg. In China, the solution that worked in the past, expanding credit to new extremes, has not generated real growth in the real economy. Kyle Bass expects a devaluation in China's currency that is beyond the control of its central bank, and analyst Andy Zai believes China is headed for a 1929-style depression as a result of its unprecedented expansion of debt. The social contract is unraveling. Around the world, the message being sent to the average citizen is, the lifestyle you ordered is out of stock. The failure of these policies to accomplish anything but widen the income-wealth gulf has delegitimized not just the policies, but the institutions that issued them, central banks and states. Rather than lay out a practical solution to the demographic resource constraints that required proportionate sacrifices from everyone, central banks and states have continued to promise what amounts to a free lunch, borrowing our way to prosperity by borrowing from future earnings and future taxpayers. The moral and financial bankruptcy of this policy is now evident to all. Now that financialization and globalization have run their courses, the central banks and states have attempted to restart growth with debt. Injections of new credit work wonders when economies are lightly indebted, but once they've become heavily indebted, adding more credit debit accomplishes less and less in the way of sustainable real growth. These trends cannot be reversed with yet another rate cut or another whatever it takes announcement of central bank bond purchases. Greater volatility and uncertainty are baked in the cake at this point, as what worked before fails to produce the rescues it once did. For the individual investor looking to preserve capital, these will be treacherous waters to navigate. Not only is another crisis approaching, but it will not unfold like the last global crisis in 2008. With the greater pressures in play now, economically, demographically, resource-wise, and politically, the fracture lines will be different and likely more disruptive. Thank you for tuning in for this week's Sand to Pearls Stock Market Commentary featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.donaldpearl.com. www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.